Welcome to the channel. Artificial intelligence continues to reshape the business world, offering enterprises innovative tools to enhance efficiency and performance. Two prominent players in this space are C3 AI and UiPath, both leveraging AI to create transformative solutions for organizations. However, their stock price trajectories in 2024 have been starkly different. C3 AI stock has surged by nearly 50% year-to-date, while UiPath has experienced a sharp decline of approximately 50% over the same period. With these contrasting performances, the critical question arises: which of these companies presents a better investment opportunity for 2025? In this video, we'll explore the answer by analyzing their revenue growth, cash flow from operations, operating profitability, and valuations. So, without further ado, let's dive into the details. Let's start by examining the stock performance trends of C3 AI and UiPath in 2024. At the beginning of the year, both companies appeared to be on a similar growth trajectory. However, by April, their paths began to diverge significantly. C3 AI saw its stock value climb dramatically, delivering an astounding 4,349% return year-to-date. In contrast, UiPath faced a steep decline, with its stock falling by 44% during the same period. This divergence has not only persisted, but has widened further in the past few months, making it essential to dig deeper into the factors driving this disparity. Revenue growth is often a reliable indicator of a company's potential, and here, C3 AI outshines UiPath. In 2023, both companies reported accelerated revenue growth. However, 2024 marked a turning point. While C3 AI revenue growth surged to an impressive 29%, UiPath faced a slowdown, with its growth trajectory beginning to decelerate. This divergence in growth rates has been a significant driver behind C3 AI's superior stock performance in 2024. Revenue growth alone doesn't tell the whole story. Cash flow from operations provides crucial insights into how effectively a company translates sales into usable cash. In this regard, UiPath has demonstrated remarkable improvement. Back in 2021, UiPath's cash flow from operations to sales ratio stood at approximately 5%. Over the years, this metric has steadily improved, reaching an impressive 23% in the trailing 12 months. On the other hand, C3 AI cash flow from operations to sales ratio remains at -14%, almost unchanged since 2021. While C3 AI did achieve positive cash flow from operations in a recent quarter and has outlined plans for continued improvement, it is still playing catch-up compared to UiPath. The latter's management has forecasted not just an increase in cash flow, but an acceleration of growth in this area. Starting from an already strong base, for C3 AI, the journey to achieve comparable cash flow metrics is considerably longer. When it comes to operating profitability, UiPath once again takes the lead. As of now, UiPath's operating profit margin stands at -13%, a significant improvement compared to earlier figures. Meanwhile, C3 AI margin, though showing progress, is still at -90%, up from a low of -110%. While both companies are moving toward profitability, UiPath's consistent and substantial advancements make it the stronger contender in this category. The path to profitability for C3 AI remains more challenging and will require sustained efforts over the coming years. Valuation plays a crucial role in investment decisions, and the forward price-to-sales ratio is a widely used metric in this context. This ratio helps investors understand what they're paying for each dollar of a company's sales. For example, a company with a market capitalization of $1.25 billion and $185 million in sales over the past year would have a price-to-sales ratio of 6.76. If its revenue for the next year is expected to reach $465 million, the forward price-to-sales ratio would drop to 2.69. Several factors influence this ratio, including profitability, growth rate expectations, market size, and cyclicality. Companies with higher profit margins, faster growth rates, larger addressable markets, and lower cyclicality tend to command higher price-to-sales ratios. Conversely, businesses with negative or volatile earnings often rely on this metric for valuation. For C3 AI and UiPath, the forward price-to-sales ratios tell an interesting story. C3 AI is significantly more expensive, with a ratio of 11.7, compared to UiPath's 4.8. While C3 AI accelerating revenue growth may justify some of this premium, UiPath's lower valuation, combined with its superior cash flow and profitability metrics, makes it a more compelling option for value-conscious investors. To summarize, both C3 AI and UiPath have their strengths. C3 AI has captured attention with its impressive revenue growth and rising stock performance. However, UiPath stands out as the more well-rounded investment choice. Its steady improvements in cash flow and profitability, coupled with a reasonable valuation, position it as the stronger contender for 2025. If you found this video helpful, please give it a thumbs up and consider subscribing to the channel. Your support helps us continue to bring you in-depth market analysis. Thanks for watching, and I'll see you in the next video. Take care.